Welcome back to The Explainer. Today, we are putting a literal healthcare giant right under the microscope. We're going to run Cencora, trading under the ticker COR, through what I like to call the ultimate stock analysis gauntlet. You know, as an investment analyst, I absolutely love looking at a company from multiple angles to find the real story hiding behind the numbers. So today, we're evaluating Cencora using the world's most famous valuation frameworks. We'll be consulting the timeless philosophies of legends like Warren Buffett, Peter Lynch, and Benjamin Graham. And then we're going to pit their classic wisdom against modern quantitative models, like the discounted cash flow analysis.
Okay, let's dive into this. Here is our roadmap for today. We'll kick things off with the company snapshot, move through the Buffett, Lynch, and Graham lenses, check out the DCF and other models, and wrap up with a synthesis and final verdict.
Section 1. Company Snapshot. Let's get the baseline facts on the table for the company we're looking at today.
So Cencora is an absolute titan in the healthcare medical distribution sector. Operating as a global pharmaceutical solutions organization, they are basically the critical plumbing of the entire healthcare system. Right now, they're trading at $303.99, commanding a market cap of nearly $60 billion. And the sheer scale here is just staggering. We're talking $325.78 billion in annual revenue. They operate in this massive healthcare oligopoly, which makes them incredibly entrenched in the market.
Section 2. The Buffett lens. But hey, sheer size doesn't automatically make something a great investment, right? Let's bring in our first guru, the Oracle of Omaha himself.
Warren Buffett's framework is famously straightforward, but it's incredibly hard to satisfy. He's looking for wonderful companies at fair prices. He demands a wide economic moat, honest management, and consistent growth. But crucially, and this is key, Buffett obsesses over high returns on equity and manageable debt. He wants businesses that generate absolute mountains of cash, what he calls owner earnings, without teetering on the edge of financial distress.
Now, what's really fascinating about this slide is the intense tug-of-war going on in Cencora's financials. On the positive side, Buffett would be drooling over their massive 133.5% return on equity and that enormous $3.46 billion in free cash flow. Plus, they operate in a $12 trillion total addressable market. Talk about a colossal economic moat. But then, look at the negatives. The leverage is literally through the roof. With $12.18 billion in long-term debt, their debt-to-equity ratio sits at an alarming 472.6. When you pair that mountain of debt with a razor-thin net profit margin of just 0.5%, well, the risk profile escalates dramatically. So looking through the Buffett lens, this is a highly contested hold or maybe even a pass. While the cash generation and the moat are textbook Buffett, the guy's famously averse to heavy debt loads, especially when profit margins offer so little buffer. At the current price of around $304, there just isn't enough margin of safety for his liking. He'd need a massive price drop to stomach that kind of leverage.
Section 3. The Lynch lens. Let's shift gears and look through the eyes of Peter Lynch, one of the greatest mutual fund managers in history. The absolute cornerstone of Lynch's mathematical valuation model is the PEG ratio. It's simple. It's the price-to-earnings ratio divided by the company's growth rate. For Peter Lynch, a PEG ratio of 1.0 is exactly fair value. Anything below 1.0 is a bargain, and anything significantly above 1.0 means you are definitely overpaying for that growth.
So we run the numbers for Cencora, and we get a PEG ratio of 4.23. We calculate this by taking their trailing PE of 23.3 and dividing it by their 5.5% revenue growth rate. To put that into perspective, in Peter Lynch's eyes, a PEG ratio over 4 is just glaringly expensive.
Let's break down the rest of Lynch's assessment. He loves categorizing companies, and Cencora is a classic stalwart, a huge defensive company that pays a reliable 60-cent quarterly dividend. He would also absolutely love the new $2 billion share repurchase program that shows extreme management conviction. But the negatives are pretty heavy here. That PEG ratio is way over the limit. On top of that, growth is actually slowing down. Recent guidance reduced revenue growth expectations to just 4 to 6%. And finally, you know Lynch loves those off-the-radar stocks, right? Well, Cencora has massive institutional ownership from giants like Vanguard and BlackRock, which usually means the easy money has already been made.
The verdict from the Lynch lens is crystal clear. While Cencora is a fantastic defensive stalwart, a 5% growth rate just doesn't justify paying 23 times earnings. Under this framework, Cencora is a sell at current levels.
Section 4. The Graham lens. Moving right along, let's consult the father of value investing himself, Benjamin Graham, Warren Buffett's mentor, and a man famous for his strict, uncompromising quantitative checklists.
Graham looks at stocks purely defensively, seeking maximum downside protection. Looking at his checklist, Cencora easily passes the size test with its massive $325 billion in sales. It also has highly stable earnings and an uninterrupted dividend record. But man, look at the failures. Graham demands moderate debt, and Cencora's 472.6 debt-to-equity ratio completely blows past that. He insists on a PE under 15, Cencora's at 23.3. And most brutally, Graham wants a price-to-book ratio under 1.5. Cencora sits astronomically higher at around 16.5.
With so many blatant failures on his defensive checklist, you really have to ask, would Benjamin Graham ever consider buying Cencora? Let's check his famous intrinsic value formula to find out.
So here is the crucial number, $85.58. By taking the square root of 22.5 multiplied by their 17.77 expected EPS and their 18.32 book value per share, we find Graham's true intrinsic value. That means Benjamin Graham, the ultimate bargain hunter, wouldn't touch this stock unless it suffered a catastrophic crash down to $85 a share. For sure, to Graham, it is an undeniable sell at $304.
Section 5. DCF and other models. Okay, so the classic value gurus are deeply skeptical of that price tag. Let's pivot to the modern era and see if quantitative models agree with the old-school gurus. A discounted cash flow model values a company based on the present value of all its future cash flows. Here are our transparent base case assumptions. We start with their massive $3.46 billion in current free cash flow. We apply a standard 8% weighted average cost of capital to discount those future dollars, and we assume the company will grow at a highly conservative 2% terminal growth rate, roughly tracking long-term inflation forever.
Now, when we run those numbers, the results are completely shocking compared to the gurus. Under our base assumptions of an 8% walk and 2% terminal growth, the DCF model yields a fair value of $607.85. Because Cencora generates so much pure cash right now, the mathematical model suggests the stock has massive upside from its current $304 price tag. Even if we increase the discount rate to 9% and drop growth to 1.5%, the stock still looks undervalued at $410.
And this brilliantly illustrates the massive divide between classic value metrics and modern cash flow models. Looking at PitchGrade's data for alternative models, the earnings power value model prices Cencora at $522, and the forward PE multiple model prices it at nearly $694. The quants look at this cash flow machine and see a stock that is deeply, deeply undervalued.
Section 6. Synthesis and final verdict. We've officially run the gauntlet. We've seen extreme caution and extreme optimism. Let's bring all these distinct analytical lenses together. Just look at this summary table. It is a fascinating split decision. The classic conservative gurus, Graham and Lynch, are screaming sell. They just cannot get past the high debt, the slowing growth, and the premium multiple. Buffett sits on the fence as a hold. He loves the moat and the cash, but he absolutely hates the leverage. Yet, when you look at modern cash flow models like the DCF and earnings power value, they are screaming buy, heavily weighting the sheer, unadulterated volume of cash this business spits out every single year.
Our final assessment really zeroes in on this exact tension. Cencora's strengths are completely undeniable. It is a cash-generating machine with an incredible return on equity, and management is literally returning $2 billion of that cash directly to shareholders via buybacks. But we simply cannot ignore the structural risks. They are carrying a massive debt load of over $12 billion, and with razor-thin 0.5% profit margins, any macroeconomic shock or unexpected cost increase could wipe out their profitability instantly. So taking every single analytical framework into account, we officially rate Cencora a highly contested hold at $304. It all comes down to one final provocative thought for you to ponder. Is Cencora's massive $3.4 billion cash flow engine strong enough to safely outrun its mountain of debt in a slowing growth environment? Until those razor-thin margins show signs of expanding, the classic value risks might just outweigh the quant model's rewards. Thanks for joining me for this explainer, and we'll catch you on the next one.